Hi, this is Abhishek Bal, and I welcome you all to my channel. Today's topic is a cursory glance on the commodity spreads because I see quite a few student candidates for FRM Part 1, 2021-2022 are actually suffering digesting some of the intricate concepts of commodity and especially finding it a little hard negotiating and meandering the problems related to commodity spread. So I thought that I'll make an attempt to make things simpler. So to begin with, commodities can be classified into two. One is the agri-based commodities. Of course, you would know those are grains, pulses, cereals, common vegetables, for example, potatoes, onion, etc. And then we also have the non-agri commodities. For example, the bullion, the base metal, energy, any natural resources, oil, Brent, natural gas, etc. Now, along with that, both agri and non-agri, but of course, to a large extent, the agri commodities are non-storable in nature because quite a significant number of those products, those commodities are the ones which are to be consumed, that are to be consumed, if not immediately within a short span of time. There are perhaps no means to store them. In contrast, some of the agri commodities, of course, they can be stored and they can be stored with proper preservatives, proper protection, and proper storage. So, mind you, only those agri commodities that can be stored with preservatives will have derivative underwriting, derivative contracts. The commodities that are consumed immediately are not the ones on which a derivative contract can be underwritten. So that's number one characteristic. Second is that, as I told you, that the storability, of course, we talked about the bullions, the base metals, or natural gas, energy, other energy sources, for example, Brent, etc. So these are the ones that fall under the category of storable commodity, with the exception of, in case of energy, with the exception of electricity. Electricity is something which are to be consumed immediately, but they can't be stored. On the other hand, there are some few properties of commodities which are of much interest. The number one of them is a hedge against inflation, or more precisely, hedge against unexpected inflation. Studies after studies and the anecdotal references point out to the very fact that against inflation or unexpected inflation, unaccounted inflation, commodities are the best bet. They are even better than equity or real estate. But along with that, commodities are the ones that are most susceptible to other economic shocks. For example, a war breaking out, a natural disaster, some sort of, or some sort of um, some sort of climatic catastrophe, or even, for example, the COVID-19, SARS-CoV-19, that crippled 2020 and the better part of 2021. One would remember that somewhere in April, May last year, somewhere between April, May, or June last year, the Brent actually plummeted below zero. So the point that I'm trying to drive home is that the commodities altogether, the storable commodities in particular, though they do provide a solid bet and a solid hedge against inflation, but they're also the most susceptible to most of the economic shocks. And the severity of these shocks are felt in those commodities that are nearing their expiry. Okay, so with these characteristics in mind, the matter of interest out here are understanding the spread measures, more notably the crack spread, the crush spread, and of course, we are going to understand in details something called as the convenience yield along with the storage cost. But before that, also let me highlight that one of the important aspect of commodities, which is basically the lease value. Now, what is a lease value? I will cover it subsequently as we move ahead. Okay, so let me first get into what is meant by the crack spread. This is mostly used in case of the oil. So when oil is extracted out of the oil well, and then thereafter, we have several layers of distillation and several layers of products and byproducts. Now, all of these byproducts have industrial, commercial, as well as domestic application. Not to speak of that they have a great export value to the OPEC countries. We all are aware of that. So I'm not going to exemplify, I'm not going to definitely define out here the chemical process of how a distillation process happens, how naphtha is actually synthesized. No, that's not the aim of the whole thing. But suffice to say that we need to understand something called as the crack spread. So what a crack spread is, in layman terms, is basically you need to understand that we have the raw product as in the form of, let's say, Brent, okay, or the crude as it is called. So once the crude is extracted through this process of distillation, we can, come out with several grades of byproducts. For example, jet oil, gasoline, then we can have industrial fuel, as has been under LPG, etc., etc. Now, you need to understand that all of them are nothing but byproduct of this. So this is the mother. This is the mother, and these are the byproducts of them. So whatever we produce out from here. However, what goes into the market are these. You don't get the Brent or the crude as it is. So what goes to the market are these things. So, but obvious that this is the refined or the processed version of this, at least a large part of it, and hence they were going to carry more cost or more price than the raw crude itself, because there are a lot of processing that's involved here, right? Great. So this understanding is sufficient as far as our exam is concerned. Now let's take a quick example of crack spread, and I'm sure that this will ease out all the problem here. So suppose the 1 month futures contract to buy a crude oil is 45 per barrel, and the 2 months future price for gasoline and heating oil are 50 per barrel and 55 per barrel. What is the no arbitrage crack spread? So what we mean by that is that whenever you'll get a question like this, please understand what it means. It means that if you extract 7 barrels of crude oil, 4 barrels of that crude oil will be produced. 4 barrels of gasoline will be produced from those crude oil, while 3 barrels of heating oil will be produced from that crude oil. So 7 is equal to 4 plus 3 here. That's the notation, that's the convention, and that's sufficient for us. So if you have to find the crack spread, that's pretty easy now for us. So all that it means is, since the units are all given per barrel, so we don't have to do any more conversion. All that we do is that we say 50 into 4 plus 55 into 3 minus 45 into 7. Okay, so if you can do the math, then this is going to give you, let's just do the math for you. So this is 15 to 4, 200 minus 15 to 4, 200, 200 plus 165 is 365. 365 minus 45 into 7, that gives us 50. So this 50 is what is called as the crack spread. Okay, now there is one more thing to it, especially with your exam. Your exam might ask you on a per barrel basis. So since the input to this whole process was 7 barrel, so all that we have to do, if you have to find out for 7 barrel, is divided by 7, and it is as simple as that. So we get, it is 7.142 per barrel, and this is your answer. Okay, your exam, as far as your crack spread is concerned, I do not think that it will have any more complexity than what is being shown out here. So the objective is actually to drive home the point how a crack spread is being calculated. Okay, so moving to the next agri-commodity of ours, which is called the crush spread. I've taken the example of the soybean crushes that actually trades on the Chicago Mercantile Group and the exchange as well. Now, the soybean, as we know, it has several applications. Starting with soy meal, you could see these are the products. We have the Nutri-Nuggets, which are very famous. You have a soy sauce, soy milk, and also soy butter as well. And then we could also extract the oil out of the soybean as well. Okay, so these are the byproducts, or you could say that these from the raw soybean, these are the things that are processed, or these are the things that are synthesized or extracted, right? These are the final products that we get into the market. Now, pertaining to this, what exactly happens? Let's understand that first. So suppose you are a trader. So what do we mean by a trader? A trader out here is the one who uses this raw commodity as input. Okay, why would he use this as an input? Simple, because he is basically a producer of either these soy meal, or let's say soy oil, basically soy oil, soybean based oil, So basically, he uses the raw soybean as input and produces the soy meal or the soy oil, right? So what are now, since you know this, so let's understand the risk that he may face. So he is facing a couple of risks. Can you name them? Well, let me just write it down here for you. So the two risks that he is going to face is, first, the increasing input cost, right? Increasing input cost. So which means that if the price of the soybean rises, this trader is going to find it difficult because his input cost is going to increase as far as the raw inventory is concerned. Okay. The second is, what if the final product that he sells in the market, these are actually soy-based products, so the final products that he sells in the market to the intermediaries or to the any other company or directly to the shelf, the prices of that suddenly plummeting, right? Decreasing decreasing prices of the growth. So these are the two risks that he faces, right? Now, if he has to secure his profit margin, then he will have to hedge this risk. So how does he hedge this risk? So we must understand that he has to take a reverse contract. So how do we go into the reverse contract? He must enter into a short contract as far as the soy meal is concerned, and at the same time, he must also enter a soy short contract in the soy oil futures, and at the same time he must also enter into a long contract as far as soybean, the raw soybean, is concerned. Why would he do that? Because he wants to ensure a fixed price as far as the purchasing of the inputs are concerned. So this is who the hedger is as well. The hedger out here is the trader, because he needs to hedge his input cost as well as the output price that he wants to sell because of the profit margin, right? Now, what is a board crush? The board crush is exactly that. It actually captures the difference between the output cost, output price, and the input cost. So what you do is short the soy meal futures plus short the soy oil futures, because this is the price that you want to sell in the market, and minus the input cost, which is basically the price at which you want to buy it long to the soybean futures. So whatever be the spread out of here, that is called the board crush, and this board crush is separately traded either in real terms or in synthetic terms on the CME exchange. But that's for another story altogether. My objective out here was to elucidate the concept of crush spread, taking the example of soybean. What is applicable to soybean is also applicable to corn as well. Now, without much ado, let's take an example and see about the last part of this tutorial, which is the convenience yield and as well as the storage cost. So I have depicted a problem here. The problem states that calculate the 4-month forward price for a bushel of soybean of the current spot price of soybean being $6 plus bushel, $6 per bushel, and the prevailing risk-free interest rate is 6%. The storage cost is estimated to be 0.04, that is 4 cents per month per bushel. Also calculate what if the storage cost is 2% instead of a fixed amount of 4 cents. All interest rates are annualized and are deemed continuously compounded. All right, so here is the solution. The first and foremost thing that we will do is we will calculate the storage cost, and that's pretty easy out here. So you see, what we do out here is that the storage cost has been set to be 4 cents per month per bushel. So it's pretty easy, since we're talking a 4 months contract. The storage cost is going to be 4 into 4, 16, 4, okay, 4 into 4 cents, that is. Yeah, so 4 cents into 4 cents, which actually comes out to be 16 cents or 0.16, right? So this is the storage cost, is it not it? No, this is not the storage cost. And why it is so? Because this simple calculation excludes the opportunity cost of it. Because please understand, we are talking essentially about 4 months. So 4 months would mean t is equal to 0 here and t is equal to 4 here, and in between we have 1, 2, and 3 months. T is equal to 1, T is equal to 2, and T is equal to 3. So each month, at the end of the month, the rent is being paid, right? So that means that starting from year at the end of year one, starting from that position, there is an opportunity cost to this, right? Because this money is deemed to be borrowed. So the first year's rent that is being paid, there is an opportunity cost for 3 additional months. Similarly, the second year, the opportunity cost is 2 additional months. The third year, the opportunity cost is 1 additional month. And the fourth year, there is no a separate opportunity cost. So we will also have to add these opportunity costs in order to find the fair value of the storage cost. So how do we do it now? Well, things is that much easy. All that we do is that we have already been given the rate of interest. The interest rate has been given already. That's annualized, of course. So we will have to convert it into month and see what it is. So let's say 0.04. So the math works out to be 0.04. That's in dollar term. And then the opportunity cost that's associated with it, and that is the first 0.04 multiplied by 1.06, and that is for 3 months. So 3 months would mean 0.25, right? Plus this is going to be 0.206. It's going to be 2 months. So 2 months would be simply 2 divided by 12, that is 0.167, and then 1.06 to the power 1, and of course the last, there is no opportunity cost, which is 1.06 to the power 0. Okay, so we have to do this math, and I'm sure that we could do this math all by our own. So in your calc, you could do it directly by pressing CF as 0, and then converting CF0, setting it at 0, and then CF1 as 0.04, and then F1 is, we're doing it for 4 months, so it is F1 is 4, and then we directly go to NPV button, and at NPV we put the rate of interest as 6, and then we put the NPV, and then we put down the arrow key, and we have the net NFV. So the NFV comes out to be 0.17498, roughly 0.175. So this is all put together is, this direct calculation of the rent and the storage cost all put together. This comes out to be roughly 0.175. Okay, so this is my storage cost. So once we have identified the storage cost, the rest of the thing is pretty easy. All that you have to do is to calculate the futures price of this SOI contract. So the futures price of this SOI contract for a 4-month period happens to be, you have the spot price as 6 multiplied by E into to the power 0.06 into 4 months. So that is 4 divided by 12. That comes out to be 0.33. Okay, this is what the futures price is. So let's just do the math quickly. 0.06 y to the power x, 0.06 into 0.33, and this becomes my second and log multiplied by 6. So this comes out to be 6.1199. So this is roughly about 6.12. So the total cost out here, including the storage cost, happens to be, so the total futures price, total cost, that including the storage cost, it comes out to be 6.12 plus 0.175. I'm sure you could do this math, and this comes out to be close to 6.295. So this happens to be my 4 months forward contract for these soybean futures. Please also understand that this is a no arbitrage price. Now, okay, so the additional point that it says is, what if the storage cost is 2% instead of a fixed value, an absolute value of 4 cents? How do we do that? Well, it becomes that much more easier. All that you have to do is set the forward price at F0 to 4 months, and this is equal to S0 into e to the power 0.06 plus 0.02, since all are annualized. Oops, let me just, okay, multiplied by 4 months, so which is coming out to be 0.33. Okay, so if you could do this math, so this is about, so this comes out to be 6.160. So please understand that this future price is on a per bushel basis. Okay, so here I have demonstrated one important concept, and that concept is that regardless of how the storage costs are given, even they are given on an absolute value or they are given as part of the interest rate, so all that we have to do is we have to, in order to find out the no arbitrage fair price of the futures contract for the given period, we either could work through the normal futures contract plus add the absolute value of the storage cost. But do remember, while you do so, that you must take also the opportunity cost into consideration, which is basically this and this would put together. Plus, in order to find out the fair price, all that you have to do is to calculate this price, storage cost, and add them to the normal pricing of forward contract. Or in other sense, if instead of the absolute value, if the continuous rate of the storage cost is being given as part of percentage, so we make the adjustment on the exponential term, because the futures price in a continuous basis for any period is given by the spot price that's existing into the exponential. Now we added the risk-free continuous rate of interest plus the storage cost, okay, for the period. So we make use of this formula, exactly that formula we have made use of. And please understand that here it is explicitly mentioned that it is 2%. This is also continuously compounded and this is also continuously compounded. If not, if the interest rate was given as simply compounded and annualized basis, and they are being said that the interest rates are deemed to be continuously compounded, we might have had to convert them into the continuous compounded mode, and I'm sure you know how to do that. Okay, so let's move to the last problem of the evening, and that's basically something which actually caught my attention in last time. So here is the thing. The hedge fund specializing in commodity related derivatives is considering a crush spread. Remember, we already discussed what a crush spread is all about. Position using soybean and soybean oil futures contract. Using the information in the table will determine which of the following statement is correct. So the spot price of soybeans and the spot price of oil is being given. The storage cost is being given. The convenience yields are being given. The interest rates are being given, which is of course continuously compounded, being mentioned, and annualized, and time to expiration, and is also being given out here. So given this, how do we go about creating the hedge? Now, as I meant before, so there are 4 options that are being given. Now I read out these options, but in an exam scenario, you first have to immediately identify that which hedges are not applicable, which means that which is the thing that you should know that this just cannot be. For example, the hedge fund should establish a short position in the soybean futures. Absolutely not, because the soybean is an input to it. He's long to that contract. He's long to that contract. It cannot be short position. So immediately, option C, that goes out of the window. Okay, so the next options that are being given, in that it is being said that he is in long position soybean futures and long position in soybean oil futures contract. Again, this cannot be the case, because he cannot be long in both. As I know, to establish the hedge, he has to be long in the soybeans, while in the soybean oil he has to take a short position. So this also goes out of the window. Now comes the next thing, that the hedge fund should establish a long position in soybean futures and short position in soybean oil. This is correct. This is the position that one should take. And option B also says the hedge fund should establish a long position in soybean futures and short position in soybean oil contract. Okay, so now the choice immediately from here boils down to these two. Now here I'm going to discuss something called as the convenience yield first. Okay, so the convenience yield, what it means. So first and foremost, please understand that the convenience yield is nothing but is deemed to be the non-monetary, and this is how your textbook appears. But what I want you to understand is that the convenience yield is supposed to be a non-cash benefit that accrues to the holder of the asset. I repeat, the convenience yield is a non-cash benefit that accrues to the holder of the asset. Okay, mind you, these words are more important. Okay, so when we calculate any futures price or any forward price of any underlying, we need to understand that futures of the forward price must incorporate all the costs that are associated, but definitely cannot incorporate any benefit out of it, because those benefits are actually going to somebody else. So suitably, those benefits are to be adjusted. In other words, those benefits are to be deducted from the costs that are associated with this to arrive at the net cost. So for example, if you have to establish a futures or a forward contract on an underlying which is a stock, and the stock pays dividend, we know it for a fact that in order to in order to find out the no arbitrage fair price of a 6 months contract or a 1 year contract, we know it for a fact that we cannot, and I repeat, we cannot do the futures or the forward price just like that unless we have taken out the benefit that is accruing to the holder of the asset in the form of dividend. Same goes for a bond. The coupons are suitably adjusted. So there is no reason why the convenience yield which do accrue to the holder of the commodities. Please do understand, in case of commodities, there are no dividends because this is not a financial asset per se. So there is no dividend, there is no bond, there is no coupon, but there is a convenience yield. So what do we mean by convenience yield? So let's understand. I'll take 3 examples separately, but I'm sure that you'll get the point. So the first very crude example is, let's say that you're a banana farm and you raise banana. You cultivate banana. Excuse me. So you're a banana farmer and you harvest banana, right? All right. So during the harvest season, once you have harvested the entire crop, you store them at your house because you have to take it to the wholesale market maybe a couple of days later, or maybe a week later, I don't know, and in order to sell them. While they're at your home, 2 things can happen. You have kids at your home, and those kids come and they kind of steal and sneak out bananas from the lot, right? So sneaking out 10 bananas from, let's say, such a huge contract, will it make any difference? I don't think so. Nobody would notice, right? Mind you, this is a very crude example, I know. Mathematically, it may not sound very logical, but that's not the point. My point is not to drive home any mathematical interest out here, but the common sense. So if your kids out there, they sneak out a few bananas out from the lot, I don't think that's going to have any material impact on your produce, right? You'd still be able to sell. Second is that let's say you have a neighbor, and that neighbor actually produces potato chips. And the neighbor says that, listen, I have an urgent need of, let's say, 5 dozens of bananas. And I can't go to the market today. But if you lend me these bananas, I promise you that not only I'm going to pay you for some rent because you have rented these bananas to me, but tomorrow I'm going to return these bananas once I go to the market. But today, I need these bananas. You know this neighbor pretty well. So you lend him, right? You lend him. So my objective here is that while the physical produce is in your possession, you still have some non-monetary benefit. For example, a non-cash benefit. Why we say a non-cash benefit? Because it's really not getting or entering into a material transaction, because those transactions are usually designated as buy or sell. Here somebody is actually lending it out, somebody is borrowing. with the promise of returning that produce back to you along with some rent. So that's really not a monetary benefit that can be counted in financial terms. But we can always say that it's perhaps is still a monetary benefit because somebody is enjoying the rent. It just may not be considered a cash benefit, right? My kids actually sneaking a few bananas out of my lot, or my neighbor actually borrowing bananas for a few hours. Well, he might actually, express his gratitude in some form or the another. He might not actually pay me rent, but he might actually, gift me, some delicious banana chips, right? That can happen, right? So this is first example. The second example which which I want to drive home is, let's say you and your friend have entered a contract to sell your flat 6 months down the line. So while you and your friend have actually entered into a specific fixed price, so your friend and you decide that the market rate happens to be, let's say, 15,000 rupees per square feet, and since it's a 1,000 square feet flat, so it comes out to be roughly, let's say, in Indian rupees, it's about 100 and it's about 15 million rupees. So that's what you and your friend have agreed. But the only stipulation that you have placed in front of your friend is that you would still, be staying in this flat for the next 6 months, and after that only you'll be sold. And your friend is perfectly okay with that. However, what has really happened is you've actually got a better deal with your friend. In fact, your friend is actually in a losing position. Why? Because he's foregoing those 6 months of rent, and yet he will still be paying at the market price 6 months down the line, right? So in this case, what has happened is that you're enjoying the rent yield at the expense of the fair price of the property. So there is a yield that is accruing to you. So this is also part of your convenience yield, right? So as I mentioned before, that if I have to derive out the fair price of the futures price, I must necessarily, you make use of the spot price, add all the benefits, add all the costs, and subtract all the benefits to arrive at the net cost. And the net costs is something that the long to the futures contract or the long to the forward contract must pay to the short. That's a fair deal, right? So in order to incorporate the convenience yields, what we have to do is that we say, well, in order to do this, I'm using first the continuous mode. Remember, what is applicable in continuous mode is also applicable in case of a normal mode. So first we say that the risk-free continuous rate, we take that, we add the storage cost or any other processing cost, and then we deduct the convenience yield. Mind you, when I say this convenience yield, I am incorporating the lease rate also out here, right? Because in case of the real commodities in the market, the holder of the asset does enjoy the lease rate as well, because there are shorters in the market who may require the commodities for some portion of time while those commodities are still in possession of the holder of the asset. So there is a lease benefit also that accrues to the holder of the assets. But I am nonetheless considering that also part of my convenience yield. So this becomes my net cost, my risk-free rate of interest in a continuous mode, plus my storage cost. This is my cost minus the convenience yield multiplied by the time. This is in continuous mode. I'm sure you know how to make it in a non-continuous mode as well. So that is also pretty easy. All that we do is 1 plus risk-free rate of interest plus the storage cost minus convenience yield, right? This whole to the power t. So this becomes the non-continuous mode, right? Great. So with the information that has been given here, please also see what the options suggest. So the options suggest that we have already established that the choice has now boiled down between option B, option B, option B, and option D. These are the two choices, right? So we have to pick up with which is the choice. So let's first calculate uh, the soybeans futures price, and that's pretty easy. So we say go to 3 months contract. So we see the 5.83 is the fair price into e to the power. So we take all the cost and subtract all the benefit. So what are the costs? The costs are basically the 11% rate of interest. plus the 63% of storage cost. Mind you, all of them are actually annualized. And then there is a convenience yield of 0.6%, so minus 0.06. So this to the power 0.25. Why 0.25? Because it's a 3 months contract. So if we do this math, so this comes out to be, let's just do this math. It's pretty easy. 0.11 plus 0.63 minus 0.06. 0.11 plus 0.63 minus 0.06. So this comes out to be 0.68. 0.68 multiplied by 0.25. So this comes to be 0.17. So we take second log and that will come to be 0.1185. This multiplied by, so this comes out to be 5.83 multiplied by 1.185, which is 6.91. All right. Okay. So this is the first contract that we've got. This is 6.91. Okay. Now, what is the second part? The second part is that the oil futures contract. So can we establish that? Yes, we can establish that. How do we do that? Exactly the same way. So it's being said in the pound manner. So we say that the oil futures is then coming out for 0 to 6 months. This is for oil. How do we do it? So we take the spot price 0.27 into e to the power storage e to the power 0.11 plus 0.06 0.03, sorry, this is the storage cost, minus the convenience yield of 0.06 into the power 0.25, right? So if we do this math, so this comes out to be 0.11 plus 0.03. Sorry, this is 0.5 because this is for 6 months period. So this has to be 0.5. Right. Okay. Zero. .280. Okay. All right. So we got then, with the convenience yield being considered, the soybean futures price as $6.91 per bushel and the soybean oil as 0.28 per pound soybean oil. But when we see between option B and D, we see that one of the answers is matching, the other not in both of the cases. So where is the catch? So the catch out here is that if you look at the options, the option does not actually ask for any of these two options, does not actually ask for the specific price of the futures or the soybean futures or the oil futures. What it asks for is, or what it actually stipulates, is that the price should not exceed no more than, so it should not exceed no more than 0.77.01 and no less than. Because why no more than? Because this is his input price. This is his input price. And why no less than? Because this is the price at which he is going to sell. So it stipulates in that manner. So it stipulates in that manner that it should not be, he should not be selling less than this, more, or he should not be buying more than this. Similarly, option D also, if you see, he should not buy in less than 0.66, should not buy more than $6.91, which is exactly matching our calculation. But the short position is that he should not sell less than 0.29, which is not matching. So where is the catch? So the catch out here is that this is in consideration of convenience yield. Now, since it is asking for a range, so the futures price should actually uh, oscillate between two prices. So one is that wherein the convenience yield is being considered, and the other where convenience yield is not being considered, because it may so happen, we are assuming out here that there is a continuous convenience yield which is occurring. This may or may not be true. Okay, the risk-free rate of interest is not in the hands of any commodity producer. The storage cost is universal, so there is not much of a thing that can be customized. However, convenience yield could vary. There is no sanctity whatsoever that the convenience yield is going to remain uniformly constant throughout the year, even for a given commodity. So we have to, in order to finding out the no arbitrage price, and since more so because the option asks for a particular range, as it should not buy at more than this price, or it should not sell at less than this price. So we have to consider both these cases, one with the convenience yield and another without the convenience yields. So how do we do the adjustment? Well, that's pretty simple. All that we have to do is to, in one case, we have to consider the convenience yield, which we have already have, and in the next case that we are going to take, we exactly have to discard this convenience yield from this position, uh, from this contract, as well as from this contract. So if we do that, let's see what it comes out to be. So if we do that, we will see that um, for the first, that is the soybeans future, so we see that if we deduct the convenience yield, the futures price comes out to be $7.01. I'm not doing the math. If you do the math yourself, you will find out. Just put zero out here and it will yield you $7.01. Okay, now, and in the other case, so so he should so and in this case, if you put 0.28, it will come out to be 0.29. Okay, so still this confusion remain. So what do we do? Since we have to find out the range, so we have to take the best and the worst scenarios, exactly consistent with this no arbitrage principle, right? So the forward price must oscillate between two prices where one, the convenience yield is being considered, it should be greater than or at least equal to that, and in another where the convenience yield is not being considered, right? So what it says is that since we have to take the best and the worst position, so what we say is that he should not buy, considering that there is no so he should not buy at more than 7.01, because that is the maximum price that he should be ready to pay, and the minimum price that he should be ready to sell, because it may be so deemed in the market after he has actually procured that he may actually enjoy some convenience yield at his end. Hence, we have to find out the worst price to buy, and also we have to find out the worst price to sell. So the worst price to buy is 7.01, while the worst price to sell is 0.28. Option B exactly fits in the definition. The only alteration out here is that in this 7.01, we have to consider no convenience yield, which is my input cost, which rises. And in the selling price, we have to consider the convenience yield, which actually depresses my selling price, right? So this is the whole thing I wanted to draw home to. I hope you enjoyed this session. It has been a pretty lengthy session, but I believe I've been able to drive home the point. And you should not have any confusion whatsoever going forward, as you know, as related problems with commodity futures and forwards, especially with convenience yield. In case you have any query, please do not hesitate to drop me an email at newavatar190 at gmail.com. Okay, thank you and good night.